What is going on, investors? Hopefully guys are doing well out there. That is right. It is Friday. That means the weekend is here. And more importantly than all of that, it's time for the Fang Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news and the technical chart patterns from all the major Fang stocks, including earnings this week from basically all of these stocks and some major drops on a few of these names, including the name that we always start things off with, and that includes Meta Platforms. This stock started the week at $125 per share. That seems like a decade ago, as the stock lost over 20% of its value down to about $99 per share. This is after the company released their Q3 earnings with revenues coming in at $27.7 billion. Look, that still beat expectations. And when I was driving in the car when these numbers crossed, and I was like, $27 billion. That's not counting the constant currency or the currency fluctuation that you've had. So it's actually a number a little bit better than that if you want to factor that in, although it was still a decline year over year of 4.5%. But what has investors very concerned, and we'll look at it here in a second, is the fact that this company is pivoting to something that is just not going to work. And now, obviously, Wall Street is starting to catch up with this company. What you're looking at here is a page on Seeking Alpha, which shows you that you have revenue estimates from Wall Street. Those is what I typically show you. But with a stock like Facebook and many of these other stocks, they're constantly being revised. And with Meta, it's constantly being revised down. And this is why I'm showing this to you, because there's going to be people out there that might make this argument that you come to a website like Yahoo or Seeking Alpha and you look at the forward PE on Meta and it's just 10 right now, just 10. You've got a market cap on this one and a price to sales and a price to earnings that looks wildly attractive. But what these people don't understand is that is based on revenue estimates into the future that are probably not going to come to fruition. And I'll show it to you more in detail here, but you're seeing just Wall Street, just red numbers across the board. The 1 month trend, the 3 month trend, and the 6 month trend is just walking these revenue estimates back. The company guided in that kind of $30 to $32 billion for the upcoming fourth quarter. This is in terms of revenue. And then in subsequent quarters, we're still having a $29 billion problem at Meta. I've been harping on it on this channel for months. Some of you are probably sick and tired of me hearing about it and talking about it, but this company has not put up a fourth quarter after the iOS changes in Q2 and Q3 last year over $29 billion in revenue, and it still hasn't happened. And then when you come over here and look at the earnings estimates, those are getting walked back even more. I mean, we're talking about 20, 30, 40% declines in earnings estimates for Meta. And that has to do with the fact that Mark Zuckerberg has surrounded himself with people that basically kiss his feet and have no courage to tell him, Mark, what you're doing is idiotic. What you're doing is stupid. What you're doing is not working. And you have evidence of it right here. Here's your reality lab. These are your goggles that you strap onto your face. And look at the revenue over the last year. It went down 50% from 558 million all the way down to 285 million. If this was a winning product, it would be doubling its revenue. It's actually getting cut in half year over year. And guess what? He just released a new product that has like a 3 times higher price tag. Do you think that's going to spur any more sales, any more demand for these things? Absolutely not. And then look at the losses from operations from your Reality Labs business. It went from $2.6 billion loss last year all the way up to $3.6 billion. And I know in Wall Street, we throw around the term billions, tens of billions of dollars. Folks, this is $3.6 billion he lost over the last year on a business unit that declined 50%. And their core business is still fantastic. Has it stalled out? Has it reached some challenges? Is it at a little bit of turmoil? Absolutely. But can this company turn things around? Has it proven itself over the years to be able to turn it around when they meet those challenges? Every single time this company has actually met the challenge and come out on the other side stronger when it comes to online advertising, when it comes to social media. The fact that they're trying to do a pivot away from social media and away from online advertising is one of the most idiotic things I've ever seen in the stock market. You see, for the last 9 months, that Reality Labs business has lost $9 $1.4 billion. That is over 1/4 of profit that you make from Instagram, Facebook, and WhatsApp. This is despicable. Mark needs to start surrounding himself with people that will challenge him. The board of directors is not doing their job at this company. The other people that were at this company that actually could tell Mark no have quit and have left. And now you're left with Mark's crazy dream of people strapping goggles onto their faces. And when you look at the sales of those devices down 50% year over year, it's just not going to happen. This stock is going to go nowhere while Mark executes on this strategy. Moving on to Apple, a company that is just incredibly well run. Over the last week, the stock started at $147 per share, ended up over 5.5% to $155 per share. This is after the company reported their Q4 earnings just a day or two ago. Revenue coming in at just $90 billion. Okay, this is not even the peak season for buying Apple products. That will come in the upcoming quarter. That was still 8% growth year over year, and it beat expectations by over $1 billion. You had essentially growth across all platforms. iPad, you saw a decline a little bit, but you saw a tremendous strength in Macintosh computers, especially when we look at Intel and AMD and NVIDIA numbers in terms of personal computing. The demand for those devices has kind of waned a little bit. Well, you went from $9 billion all the way up to $11.5 billion on those Macintosh products. They're grabbing market share because they have a better product at Apple. Now, for the upcoming quarter for Apple, that would be their fiscal Q1, but it's the calendar Q4, obviously, that we know here in the United States. They're expecting still $127 billion worth of revenue. Now, the 6-month trend from Wall Street analyst estimates has walked that back a little bit, but not a whole lot. And what I'm noticing is analysts are a little bit more bullish towards the first half of 2024. So analysts are already starting to look into that future, and they're starting to actually walk up their revenue estimates for Apple. And that is what I think is going to happen on Wall Street. There's so many people in my comments on Twitter that are talking about the next rate hike, like next week, or they're talking about what's going to happen in January or something like that. What you have to realize is Wall Street's going to just pass you by. Okay. Next week's rate hike is not going to mean much. The next CPI report is not going to mean much. What you have to start looking for is a year or 2 years from now. And then you have to factor in that analysts and investors are actually going to accumulate ahead of those good results. I think the back half of 2023 and into 2024 is when the recovery is actually going to materialize, not only in the economy, but all the stocks that we're looking at. So if you wait all the way into next year to finally get kind of the green checkered flag, like go ahead and buy stocks, the Fed has pivoted, interest rates are going down. Well, all of a sudden, all of these stocks will have already priced all of that in. That is why I suggested over last month, which was one of the worst months on record in the stock market, I was recommending accumulating stocks when things are bad. And now we're in the months of October, which has been one of the best months outside of a handful of stocks like Meta and then maybe Amazon as well. From an earnings perspective, they have been walked back a little bit with Apple in terms of those estimates, but things are still looking pretty good. I think the most impressive thing from Apple's earnings report was the fact over the last 12 months, this company had $99 billion worth of net income. You could pretty much just drop the mic right there. But in terms of the cash flow from the operating the business, obviously some of this is non-cash like depreciation and stock-based compensation. You had $122 billion worth of positive cash flow in the company, and they did over nearly $95 billion worth of either share buybacks or dividends for you, the shareholder. So off of $122 billion worth of profit running or cash flow running through the company, over $95 billion of that was actually spent just strictly on buying back the stock and dividends. That is why this stock really should be the cornerstone of your portfolio. And if it's not, and you invest in index funds, well, newsflash for you, it actually is. Now, Apple is hiking U.S. prices for their music, TV, and other services, usually by maybe $2 to $3 per month. We saw on the earnings report that we had, you definitely had a little bit of a slowdown in terms of this service revenue growth, but those gross margins are still in place. And so these price hikes, while we won't see them immediately, obviously these price hikes go in effect relatively soon, but in terms of hitting the tape over at Apple, it'll take some quarters, but this time next year, those $2 to $3 will just flow right down to the profit and bottom line of this company. Sure, you'll have some cancellation and some churn and some switching to a Spotify or a Netflix or whatever people decide to switch to, but there'll be enough people that retain their subscriptions that a lot of this will flow right down to the bottom line. Moving on to Amazon, start of the week at 119, end of the week down over 13.75% to $103 per share. Although when we were doing our earnings video on Amazon yesterday, it was down, I think in the after hours, like $88 per share. So that won't show up on the 52-week range. The 52-week range is still down at like $97. And I picked this stock up today, I think at about $98 per share. But just keep in mind, during the after hours, there was just this massive sell-off, and it was for good reason. So the individual quarter that Amazon put up really wasn't that bad. $127 billion worth of revenue. That was strong growth year over year, over 14% growth. It did miss expectations by a little bit on that revenue side. They did beat on that earnings side. I mean, they basically made no money on that $127 billion worth of revenue, but that was what Wall Street was expecting. It was really that fourth quarter guidance. So I don't know if Amazon is just laying such a low bar that they can just now jump over this, but they're expecting just between $140 and $148 billion worth of revenue in the upcoming fourth quarter. The Wall Street estimates were closer to $155 billion. I mean, we're talking about a $10-15 billion higher than where analysts were expecting that. Now, there were some really interesting things for Amazon, and some of it actually pertains to the other stocks that we're looking at. We obviously talked about Meta and how they're just blowing a bunch of money on some stupid side project that Mark's got in his head, but their core business, their online advertising business, is actually contracting. Okay. What we saw over at Amazon was their advertising business actually reaccelerated. So that was actually really exciting. On a constant currency basis, their advertising business at Amazon actually increased to 30%. The last two quarters, it grew just 25 and 21%. So they did a nice job reaccelerating their ad business. That is now a $9.5 billion quarterly run rate just on their ad business. And obviously you can continue to add, between 10 and 30% on that, probably for the next, I would guess, the next couple of years. And so you've got a gigantic business in the works there. Your subscription services business, obviously, are those Prime subscriptions. That's up to nearly a $9 billion business as well. Now, the disappointment was AWS. That grew just 28% in constant currency. That's the lowest growth rate that they have reported here over the last year or so. If the company is not able to reaccelerate those revenues in subsequent quarters, this company is going to have to make some changes in their online stores and their Amazon.com quote core business. This is why when I get on here and I talk down unions and I talk about replacing the million employees, or at least a portion of them, with robots or with machines, this is why. And that might offend some of you, but this is not the I'm trying to be everybody's friend channel. This is the investor channel. And Amazon is going to have to make some big changes in the next year or so. Certainly investors are going to give them the leeway and the courtesy to do that. Now, some investors certainly bailed on this stock today, as again, it was down 6.8%, and over the last week, down 13%. So there's clearly some investors that don't buy that this company is going to be able to make those changes. I am one of those investors that believes they probably will be able to make these changes. They need to get rid of some employees. They need to make the employees that they have more efficient, because they have some wonderful business models here underneath their core business. Their core business, though, is too expensive and operates on too low of a margin. Now, Amazon stock lost its $1 trillion market cap. This was earlier today as was down over 12%. I think it's still a $1 trillion market cap, but this does have me hoping for the future. If you're buying stocks today, like I am, like Amazon, I bought more shares of this stock today. I essentially averaged up in my price. I am buying this stock today at a $1 trillion valuation, assuming that and it's going to be it's not if, when I sell this stock, it'll be $2 trillion, maybe even $3 trillion. The lower the valuation, I think obviously the higher upside. Now, PayPal stock jumped earlier today as Amazon enabled Venmo payments ahead of the holiday. I like Amazon's strategy here. Instead of having this really closed loop in their platform where they only accept their own proprietary payments, I do like that Amazon has opened up, I think, to like Affirm. They've opened up to Venmo, and they've opened up, I think, to maybe some crypto, or they've talked about that. While the closed loop system is good for some companies, I like that Amazon has really broadened that and opened it up. Moving on to Netflix. This stock is just leading the pack here. This stock started the week at $287, up another 3%. This thing keeps ripping up to over $295 per share. This is after Netflix expanded their merchandising deal into Walmart stores. Just another little incremental thing that Netflix is doing. I'm not a shareholder in Netflix, but I do really like what they're doing. They're expanding obviously into ads. They've introduced gaming. They're expanding their merchandising. I think this company is going places, and certainly other people do as well, as the stock price is reflecting that. Moving on to NVIDIA. This one ripped way higher. Started the week at 124. Is that right? Up 11%, all the way up to $138 per share on no news. So that one just catching the momentum wave. Moving on to Google. This one started the week at $101 per share. Was quite a bit lower actually. It was much closer to $90, down just 4.75% to end the week close to 96.29 on Google. Alphabet dipped 5% though earlier this week after they reported those Q3 revenues and their profits that missed those forecasts. So here's this in kind of a visualization form. So you have your revenue estimates for the upcoming quarter. That's the fourth quarter for Google. That's going to be about $76 billion. That was a pretty good chunk of change underneath expectations. I think the original estimate just a couple of months ago was like for $83 billion in revenue. So you're seeing with Google year over year growing their ad business at just 1.89%. That's why when we talked about Amazon, I highlighted that they grew their ad business like 30%. And so the money is just shifting. Okay. That ad money is still out there. It's obviously going to TikTok. There's still large budgets still going to YouTube and Google and Instagram and those places, but we're not seeing it incrementally. That's why this company, you're investing in it now. Your hope is that in a year from now, when the economy gets a little bit better, maybe gas goes down a little bit more, and instead of being kind of in a contraction mode, that we get back into expansion mode, not necessarily just here in the United States, but around the world. Well, obviously that expansion will help all advertisers, but particularly Google. And you're seeing it kind of graphically here. You look like Wall Street's expecting sometime in the back half. And again, this is my view, my kind of broader macro view as well. In the second to third to fourth quarter of 2023, that's when you're actually going to see the evidence, probably in GDP, in inflation, in consumer confidence, and all the little data points. That's when you're actually going to see, and obviously with earnings with these companies as well, that's when you're going to see the consumer is back and things are going to be good. But if you wait all the way to that time to buy stocks, I don't think you're going to get them at the best price. The time to accumulate is before all of that comes to fruition. And you're noticing that Wall Street has this stock reaccelerating to double-digit growth towards the back half of the year. Again, that is why we started to accumulate stocks like Google earlier this month. Google acquired AI avatar startup Alter for just about $100 million. Pretty small acquisition by the size of these companies. Google was fined $113 million by India over payments abuse. This is after the company was fined $162 million. I think it was just last week for that Android operating system. I tell you what, India is just out there getting the bag from Google. Moving on to Microsoft. This one started the week at $244, also also reported their earnings. I believe it was on Tuesday. End of the week down about 3.4% to close the week, closer to $235 per share. This is after, again, those Q1 earnings. And I had a lot of people say, well, you're saying Q1 earnings for Microsoft. Understand that all these companies are on different fiscal quarter systems. So in Microsoft's case, Q1 is most companies' Q3s. Their Q2 is calendar year Q4. Look, if I was in charge of the SEC, if I was in charge of accounting, I would make all of these companies go on the calendar quarter system, but they don't. And so that's what you just have to deal with. But their Q1 earnings came in earlier this week. Revenues came in at about $50 billion. That was still solid, 10.6% year-over-year growth for Microsoft, but they gave a very dampened kind of guidance that you had to listen to on the conference call, and we talked about it on our Microsoft video. It was well underneath expectations, and when you come over here and look at these expectations, the expectations for Q2 is now closer to $53 billion, and you see just really across the board for this company, at least from a revenue perspective, Wall Street just keeps walking back these expectations, but like most of these companies, their fiscal year Q1, which is about 3 quarters away, again, in the summer to fall of next year, that is when Wall Street sees reacceleration of these revenues. That is my macro view. If it's proven wrong, you'll just have more time to accumulate these stocks. From an earnings perspective, similar type thing, but not quite as drastic as a drop off on that revenue side for Microsoft. Moving on to Tesla. If you followed me into this one, you were up big time this week. Start of the week at 204, closer to 205, up over 11.5% to $228 per share. That level of support, which you'll see in the technical segment of the show. It's amazing how when it does hold, it's almost like amazing, but that is what technical analysis is all about. Now, Tesla did clear that Twitter overhang deal. Now, that overhang is now, I guess if Twitter loses a bunch of money and they have to put more money into the company, which I guess is conceivable, maybe you have the overhang into the future, but we'll see what happens. I've always viewed kind of what Elon Musk has been doing with Twitter as separate to Tesla. Yes, he's had to sell Tesla shares, but look, if he is selling Tesla and it's going down because of Twitter, that makes me want to buy Tesla even more, not less. And also, he now has basically complete 100% control of one of the largest social media sites in the world, and one that has probably the largest political influence as well, which is certainly beneficial if you're running a company. Just ask Jeff Bezos and the Washington Post. Now, the next hurdle could be a DOJ probe, which we'll talk about here in a second, and China and U.S. recession. Now, Tesla Autopilot claims attract an SEC and DOJ investigation. What aren't these people investigating? Apparently, they're going to look into the automobile maker's advertising claims, and that made me scratch my head a little bit because I don't think Tesla advertises. Look, I just drove 8 hours both way to Las Vegas. About half the time I have the Tesla and Autopilot. The darn thing works very nicely, and it corrects if the person next to you is kind of drifting into your lane. I think it's a fantastic product. I've never had any problems with it. Now, Kathy Wood is pumping her book saying that Tesla should expand its market cap by 10x, come on, with a cheaper EV. But I do agree with her assessment here, okay? This last year or so with Tesla, it's all about pumping the cars that they already had, okay? Basically just scaling up the Fremont factory, the China factory, the Tesla, and the Berlin Gigafactories. The Texas and Berlin haven't quite scaled up, so there's still maybe another 6 months there that you have. But after that, it's going to be all about the new products and new product execution with Tesla. We obviously have the semi-truck being rolled out. I'm going to try to go to that event. I think it's a couple of weeks away. That is somewhat of a significant product for Tesla, but then you have that Cyber truck, which I think is going to be a very expensive truck, but one that will probably sell relatively well and probably have extremely high margins. So how does that rollout go? How many of those they can pump out? And then the next stage of growth for Tesla, I 100% agree, is a quote unquote cheaper. How much cheaper of a car? It obviously depends on raw materials and how cheap this company wants to go with their products. You have to be careful with a brand going too low of a price, but obviously if Tesla can put out obviously with inflation, okay, the price of things is a little bit different, but anything south of a $35,000 price tag on a car certainly can be beneficial. If they can get it under $30,000, certainly could really expand the market for Tesla. And if they can do that at the margins that they are generating, kind of the mid 20s to nearly 30% gross margins that they are on their existing vehicles, yes, I believe this company will go from its current market cap very easily to a double, probably in relatively short order. Now, Tesla saw a 65% jump in revenue from China, but their headwinds are starting, and that is evidenced by the fact that Tesla cut its prices in China by up to 9% amid softening demand. I think there's a lot of people that wanted to buy an electric car over the last year and a half or 2 years. Those people already have a car, and it takes a while. You're driving your Tesla for a while before you want to buy a new one. You also have these cars being relatively expensive, mainly affluent and well-off people tend to buy these cars. And so that's obviously kind of niches down your market as well. And then obviously on top of that, you have China, which is clearly not immune to any of the economic stuff that's going on around the world, probably actually is leading the world into a recession. And certainly the way they've handled the virus and those types of things, well, probably impacting it maybe more so than you're seeing here in the United States and maybe other parts of the world. But look, this is part of the wave, okay? You don't just buy into these stocks and watch them go straight up, okay? Look at the year chart we have on the right here with Tesla. It's gone up, it's gone down, it's gone up, it's gone down. Look, if you can't stomach that, then a stock like Tesla is absolutely not for you, and probably the stock market in general is probably not for you. You should just talk to Chuck and put it in one of those automatic little investing things and just worry about your golf swing and your biceps. Moving on to the technical segment of the show, we've got the SP 500. We've had this area of support that we had marked out here. We call it 3,500. It's really probably closer to 3,600. We wick through it. It acted as a very nice level of support. We're making our way up, having a nice little rally in stocks, but I am not that excited from a technical perspective yet. I would expect this rally probably could continue with this, and it probably could continue all the way up here till about 4,100 on the S&P 500. That would be another 5% increase on the S&P 500 before you met really what is holding these markets back from a technical perspective, and that is a series of lower highs that you've been making in the S&P 500, really dating back to the December timeframe. In order for this downtrend to be over, you really need to get above the $4,300 mark on the S&P 500. That would take you another 9% higher than the close today at 3,900. If you are able to do that, that would be a very positive thing from a technical perspective. But what we are expecting here on the channel is probably I'm expecting another 5% increase on the S&P 500, not necessarily next week or over the next 2 weeks, but probably over the next 4 weeks. I think you probably can expect that, and then probably getting rejected again and likely retesting at least down here to 3,800. But this is what you do when you form a bottom and when a new uptrend is starting. You don't just go parabolic, certainly individual stocks can go parabolic, but we're not going to see the S&P 500 go parabolic. I just don't see a scenario where we could do that, but we could start a new trend where we made some lows here, some higher set of lows. When we get to the Apple chart, that is actually what you're going to see starting to materialize. Now, this is not the Apple chart. This is one of the most sad things you possibly can look at, especially if you held onto Meta this entire time. I am not here to rub it in, and I'm not here to pat myself on the back, but we talked about after this initial drop from 300 down to 200. I mean, I had people saying they were unsubscribing from me. They couldn't believe that I had just jumped ship on Meta all of a sudden. This was back here at like $200 to $220 per share on this one. I was like, I'm out of this thing. And I actually took a lot of heat for it. Well, look, not all the decisions I make work out relatively well. This one did, because as you can see, we've gone from that $200 level all the way down here to $100 per share. If you've held on this entire time, you gotta learn how to take profits. You gotta learn how to get out of stocks. You don't have to get out your 100% of the position, but you gotta learn how to sell some of these things, especially when they're pivoting their business and they're making the decisions that Mark was making. Now, I'll have to put a line in here because it's probably hard to see on your screen. We're down here at this red line that now we're starting to create a little opportunity with this stock. Okay, you got this big gap here. When we get to Netflix, you'll notice Netflix did the same thing. It gapped and it crapped and it gapped and kind of crapped again. Well, eventually it'll turn things around and we'll have these gaps to fill. You have a gap between $100 and $130, which will probably fill virtually overnight over at Meta. That is where I'm looking to get back into this one. I am kind of off of this stock, at least in the shorter term. We'll obviously keep covering it here on the channel because I think it's a fascinating story what's going on. But from a technical and a fundamental perspective, Meta is a complete disaster. Now, you see here with Apple, I'll clean this up here in a second, but what I have here in the purple lines is what I believe is the beginning of an uptrend with this stock. We'll see if it ends up materializing. It could not materialize, but I want to emphasize the dominant trend, at least in the very shorter term with Apple, is still a series of lower highs. Since the beginning of the year, we've made lower highs. Now, it's not a steep set of lower highs that we'll see with certainly like an NVIDIA or some of the other stocks that we'll look at here. It's a pretty shallow set of lower highs. But what I've noticed more recently is we made some lows back here in June, like a lot of stocks, and then we were on the verge of getting back down there in October, but we did a very quick reversal on this one, and we've bounced off those lows, and we're starting to walk our way up. This is what I project happening with the S&P 500 over the next several quarters. That is why I'm accumulating stocks on the way down. I am not accumulating stocks as they go up here because eventually this will hit some resistance. In fact, there is a small area of resistance with Apple here at about 158. For Apple to really push up over and above that would actually be surprising. But if it does, we should have, I mean, look, if you think these lower highs are just going to finish in lockstep, you've still got some tremendous run left on Apple. This thing could rally another 10% from where it's at right now, all the way up to about $172 per share, and create another series of lower highs and then likely get rejected at that point. But I'm still thinking we're going to create another higher set of lows here and eventually start this uptrend with this stock. The primary reason we believe that with Apple is they're spending like 80% of their cash flows, which are significant. Look, any other company spends 80% of their cash flows, and we're talking about like $1 billion or $2 billion or something like that. We're talking about $90 billion of Apple actually goes into like buying back the stock over a 12-month period. That is just so much support underneath the stock that, yeah, you have to expect it to likely reverse. Now, speaking of reversing, Amazon had a big red candle going on yesterday as the stock, when it reported earnings, I think was at 110 or so, and it was all the way down here at like $88, $89 when I was reporting my video. Now, it reversed very nicely, started the day down here at about $90 per share, reversed all the way to 103. That's how you know your technical patterns are pretty tight. We've talked about this $100 level with Amazon, and it was just a quick I mean, this stock spent just hours below that price today before it snapped all the way back up to $100. I'm still not anticipating Amazon being able to break out of this trend. You've got these steep downward black lines that I have here, very steep lower set of lows. Again, we saw with Apple, they're more shallow. With a stock like this, they're very steep. For you to really bust out above them, you'd really have to have a strong move with Amazon. I don't anticipate that happening anytime soon. So I think you can, if you believe in this stock in the longer term and you believe that this valuation is going to go, it's right now right around $1 trillion. If you think they have the odds of getting to $1.5 trillion, which would be a 50% move, or $2 trillion valuation in relatively short order, which I personally do, certainly $1.5 trillion would take you just back up to 145, basically a resistance level with this stock. I certainly see this stock being able to do that in relatively short order. I'm accumulating these shares now. Certainly your downside is back down into this green box, but considering how quickly the sellers evaporated and the buyers accumulated, you can assume that anything south of $100 is being bought very aggressively at Amazon and is being sold relatively relatively not aggressively. Moving on to Netflix, there's not much to see here other than just absolute pure beauty. It is one, we talked about it for many months here on the channel. Once you got above 250, it was basically clear skies and no turbulence. I'm anticipating at some point we get a pullback on this one. I don't know if we get all the way back to 250, but if you like this one, I think you're going to want to buy it on the pullback because you're creating, series of higher lows, higher highs on this one. That is an uptrend, and that is when you really want to buy the dip. And I really like what Netflix has going on. It is possible, if this momentum stays, we come all the way back and retest 330 on this one. And if you're able to do that, that is where you should meet some pretty hard resistance with Netflix and see a pretty sizable pullback. That is when you would want to pick up that one. Moving on to NVIDIA, this one actually has done something pretty nice from a technical perspective. So we have these pretty steep, I have these red lines here, these obviously this downward channel, and I have it really tight. Okay. The channel is probably more like this. Okay. If you want to compass all of NVIDIA's candles over the last 10 or 12 months or so, you would do it like this, but I have it really tight to show you when you get these little breakouts. So you've had a breakout more recently with NVIDIA, and it's been a beautiful kind of buy off the lows here. Anytime this stock has kind of hit this channel, you could have bought kind of the breakout to the top and then make sure you're taking your profits. If you did that, I probably would be taking profits on NVIDIA right now. The good news is on the way back, you should have some support at 128 on this one. So sitting at 138, you should have some support on this one. I'm still calling for a much lower drop on this one. When you looked at Intel's results, we didn't talk about that in the news, but you might have saw my video. Intel's results were still showing you that these chip makers are under pressure from a revenue and a margin perspective. And I anticipate NVIDIA, AMD, all of these companies putting up very bad earnings reports, but it could be the case that that's already priced into some of these names and priced into the market to a certain degree, and investors don't care. In the case of NVIDIA, it still has such a rich market cap and a rich multiple that it's not the risk I want to take, but certainly there's some reward here if you're willing to take that risk. Moving on to Google, this one wicked down all the way to about $90 per share. I think even in the after hours of reporting earnings, I think it might even got south of $90, but similar to Amazon, although not quite as violent, boom, it snapped all the way back up to about $96 per share. We were at $96 per share on this one like 2 weeks ago. This is still a stock that I think you can accumulate in this range, just understanding that yes, you can continue on down this black line, creating lower sets of lows, but at some point you should reach some kind of rally where you retest the top of this range, where if it happens in relatively short order, would still be like a 9 to 10% move on this one. Obviously, we saw this week, NVIDIA had a 10% rally, and along with Tesla. Moving on to Microsoft. This one looks very similar to Google. It's still in this downward channel. I believe you can accumulate those stocks. Technically, you probably want to wait till they kind of pivot like a Netflix, or have a pattern that starts to develop like maybe like an Apple, where you're starting to develop these kind of higher low patterns. But considering what we know about these companies from a fundamental basis, and also both Google and Microsoft are executing rather large buybacks as well, you have to assume that these patterns will start to set up very similar to Apple, despite them being somewhat different business models. Obviously, depending on your risk and your risk tolerance, you can wait for that to materialize. I'm very comfortable with my analysis that I've done on these companies. I obviously spend hours doing it here on the channel, but obviously privately as well. Finally, Tesla, we had that level marked out, these series of higher lows marked out for basically almost 2 years, well over a year and a half. We talked about it, I think, on last week's show and the week before that, that when it got down here to about 210, that was when we started buying. I actually aggressively bought Tesla, which for me, I think was about 10 shares. That was, look, in an IRA account, $2,000 is a lot. And we've had a nice rally off of those lows. You've moved, roughly 10% again this week. From the lows, you're up over 15%. I think this just continues to move up. If the momentum in these markets stays, well, the momentum in Tesla stock's probably going to stay. And here's the beautiful thing about Tesla. This is why I was aggressive down here buying, because look, it's just money. If I look, I can't talk about losing my children or my family. I can very comfortably talk about losing money. It doesn't mean anything to me because I can go back and make more money if I need to. So don't treat money like your children and like your family. It's not even close to being on the same wavelength. And look, if you want to make money, you've got to risk it. With Tesla, if we bounce from these lows down here at about $200 per share and we just retest, we're still in a downtrend, okay? We just make another set of lower highs. That is a 45% move on this one. So I will take some profits with Tesla. That is probably what's making me different than the perma Tesla bull that will just kind of accumulate and never sell. I actually sell my Tesla shares when they make these technical moves because this stock really trades very predictably from a technical perspective. Now, it does that until it doesn't, but if you are able to very disciplinedly trade this one, you can make a lot of money on Tesla, and that is my plan. I aggressively bought down here because I will sell not my 100% portion of my Tesla investment, but I will sell a small portion of that. Let's say I bought 20 shares down here and it does what I think it will and rally close to 270, 275, 280. Out of 20 shares, I'm probably selling half of them and pocketing some cash because guess what? I anticipate Tesla getting rejected here, retesting probably 210 again, and I'll buy again back down there. That's just how I'll play it. How would you play it? I'd love to hear in the comments below. Have a wonderful weekend. Be safe during the Halloween. I think Halloween's Monday, but there should be some trick-or-treating. Don't eat too much candy. That's what I'm telling myself. And we'll see you again next week. Thanks for tuning in today and good luck with your investments.